hand over to James Turk, and it's a pleasure to make this introduction. Thank you, James.
Thank you very much, Tony. As you could tell from the background information that Tony provided, my experiences in the area of money and banking. So where I want to focus on today is when you take that Doré gold bar and it goes to the refinery and it comes out the other side in the form of a 400-ounce bar, there's a fundamental change. It goes from a commodity to money, and that's what I'm going to be talking about here this afternoon. I always like to start with this table. This is an analysis, it presents gold's rate of appreciation against 9 of the world's major currencies going back over to the beginning of the decade. Now, the interesting thing about this particular table is there's very little red on there. Without any doubt, gold has been one of this decade's best performing asset classes. And if you look at the bottom of the chart, these are the 9-year averages, what gold has generated each year on average against each of these 9 major world currencies. And I haven't even put down there what gold has already done this year, which is again double-digit rates of return against all of the world's major currencies. Now, my expectation is these rates of return are going to continue, and they're going to continue because of what's happening in the world's financial and monetary system. So the outlook for gold remains very, very bullish. I want to use this particular chart to explain why gold is money. This is crude oil prices, and this is a base 100 analysis. In other words, I'm going back to January 1950. I'm assuming that it was 100 in January 1950, and then I took the actual price movement over this period of time so you can make a comparison. So what cost 100 in 1950 at the peak here cost 7,800. In other words, a 78 increase. And even here presently, this is as of the end of April, cost over 6,000, 60-fold increase in the price of crude oil against the British pound. The price of crude oil in dollar terms has not risen as much as it has risen in British pound terms. Remember, we're comparing this against the same standard, a barrel of crude oil. The euro has preserved purchasing power the best, or in other words, it's lost less purchasing power because of inflation than the other 2 currencies. But note that this has started rising fairly dramatically during the period of the euro, and given the events of this past weekend where the ECB did a 180-degree about-face and announced that they're going to start purchasing government bonds, one has to question whether or not the historical record of the Deutschmark is now going to be changed significantly because of what is happening at the ECB. Look now at the 4th currency, the price of crude oil in terms of gold. It's this red line across the bottom. If we were still on the classical gold standard, we would not be talking today about the rising price of crude, because the crude oil price isn't rising. What's really happening is because we calculate prices of goods and services in terms of US dollars or British pounds or some other national currency, we only think that the price of commodities is rising. In reality, commodities are not rising. It's that the currencies are purchasing less and less and less, and it's reflected in terms of higher prices. While gold is not an investment, it does exactly what it's supposed to do as money. It maintains and preserves your purchasing power over long periods of time. And importantly, gold does this without counterparty risk. In other words, when you own a physical asset, when you own an ounce of gold or a kilo of gold, you own a tangible asset, and the value of that asset is not dependent on some bank, some central bank, or some government's promise. And in a period of financial uncertainty like we're going through at the moment, that particular unique characteristic of gold is extremely important.